It's October 17th. Right now, the market is sending two completely opposite signals. You have aggressive speculation on one side, clashing directly with deep systemic fear on the other. And this conflict has brought us to a critical inflection point. So let's break this down. The entire market structure is now defined by a risk-on speculative breakout literally colliding with a risk-off systemic breakdown. This is not normal price action. This is a battle for control, and one of these forces is about to win and win decisively. All right, let's start with the bull case. The thesis is a powerful institution-driven breakout, and the clearest evidence for this is happening in the rare earth metal sector. This is where the big money is placing its bets. Look, this isn't just about simple momentum. This move is being fueled by real-world drivers. You've got geopolitical tension between the US and China. You've got strategic demand from defense and semiconductors. And you have direct government investment. We're even hearing that some central banks are diversifying into industrial metals, treating them almost like a new form of gold. And this number right here tells the story. 200 million shares in a single stock on a breakout day. That is not retail activity. That is the footprint of urgent institutional accumulation. They are buying with size and conviction, which signals they're preparing for a long-term bull market here. Now, let's look at the other side of this war, the antithesis. While the institutions are snapping up speculative metals, classic fear indicators are flashing bright red. And it's all coming from major stress in the financial system. The divergence here is just stark. The S&P 500 was down, a modest 1%? Meanwhile, the regional bank index, KRE, got hammered, down 8%. Some of the individual names were down as much as 12% in one session. This isn't just underperformance. This is the market signaling a potential crisis. And you can see how capital is reacting to that banking fear. We're now in the 9th straight week of gains for gold. A parabolic, fear-driven move like this is historic. This is a textbook flight to safety, a direct hedge against the weakness we are seeing in the banks. And that fear, it's now officially priced into volatility. The VIX has closed above 25. Now, historically, a weekly close above this level has preceded sustained periods of high volatility. The market is officially on high alert. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice. Okay, so you have these two powerful, conflicting forces. They've brought the S&P 500 to a critical inflection point, and the entire battle is now being fought on a very narrow, options-defined technical level. These are the only levels that matter right now. Dealers have built a support floor around 6550 through their hedging activity. Above us, you have major resistance at the 7,000 gamma level. Below, the next real line of defense is the 6,000 put wall. The market is essentially trapped between these forces. Now, this is the key risk. A sustained break below 6550 forces dealers to flip gamma. That means they have to start aggressively selling their hedges. This unwinding process can trigger a cascade of selling, which accelerates the move down. That is why the 6550 level is the absolute line in the sand. So this gives us three very clear scenarios. The base case is that we stay trapped and just chop around above 6550. The bull scenario is that support holds firm, the institutional buying thesis takes over, and we push towards 7,000. And the bear case, well, support fails, the gamma flip happens, and we target the 6,000 put wall. So, how do you position for this? Let's talk strategy. In an environment this uncertain, options with defined risk are the way to go. I've got three setups here that align with the current market conflict. All right, to play the bear case, we're going to target the weakest link, regional banks. The thesis is simply continued underperformance. A debit put spread on KRE gives you a defined risk way to profit if support breaks. The trade is invalidated if, and only if, the sector decisively reclaims its recent highs on a weekly close. For the bull scenario, we target a leader. The thesis here is that if 6550 holds, strong names like AMD are going to lead the rally. An out-of-the-money debit call spread lets you play for a breakout above the $240 resistance level, all with capped risk. Your invalidation is simple, a rejection at that level. And finally, a non-directional play. Let's be honest, the gold rally is parabolic and technically very overextended. A bear call spread against the massive $400 call wall is a simple bet that this historic run is due for a pause or a pullback. It profits from time decay as long as the price stays below that major resistance. Not trading advice, just a market update to keep you informed.
Markets carry risk, trade your plan, manage downside, and verify all data.
So it all comes down to this. The entire market conflict hinges on one level, S&P 500 at 6550. This is the battleground. And the question now is, which side wins? Will it be the institutional greed fueling that metals rally, or the systemic fear that's draining the banking sector? The price action right here is going to give us the answer.